So how do you know if something is probable? It's understood to be a 50-50 test. So if it's 50.1, if you assess it to be a 50.1 chance that you're going to use it, then you now it as probable that you will use those deductions or losses. So it's a more likely than not test. So often you do your you put your evidence, your positive and negative evidence. So your positive evidence might include a management forecast that shows that you'll be using those losses or those deductions. You might have acquired a new business which improves your profit. A negative evidence would be obviously sustained losses. So you compare the two and then you make a decision whether or not you can recognize a deferred tax asset. Note here, you can recognize an amount of DTA to the extent that you have a DTL, and we'll come back to that. So, common question that we get. So, firstly, I have impaired an asset, so my investment in a subsidiary or a CGT asset. Can I recognize a DTA on that unrealized loss? That's what it is, an unrealized loss. So because it's an unrealized capital loss, you need to demonstrate two things. One is you have an asset in the balance sheet that you can dispose of at a capital gain, and it's probable that you're going to realize that gain in the foreseeable future. So it is a bit hard to I guess, demonstrate sometimes. The second one is I don't recognize anything for DTA, temporary difference. I don't recognize anything. I don't recognize anything for losses. Do I need to recognize the DTL? So coming back to what I said earlier, you can recognize a DTL to the extent that you have DTA, so it offset each other to zero on your balance sheet. That's why you see certain balance sheet that has no deferred tax balances. That is why.